Anybody here play baseball? Anybody play baseball in high school? You play softball. That'll do. You have 9 innings in softball, right? Or do they? Is it 9?
Well, I watch a lot of baseball too, so I guess
Okay,
it kind of,
alright.
yeah.
Well, let's talk about baseball. Okay. If you go to a baseball game, there are 9 innings, right? 1, 2, 3, 4, 5, 6, 7, 8, 9. Correct? So you have these innings. You have the visitors, and then you have the home team. Is that correct? Okay. Let's say we go to a baseball game. First inning, there's no run scored. Second inning, there's no run scored. Third inning, there's no run scored. Fourth inning, the visitors have 2 runs. Home team doesn't score any. Fifth inning, no run scored. The 6th inning, the visitors score 1 more run. Home team scores 2 runs. So now it's what, 3-2? 7th inning, no one scores. 8th inning, no one scores. Going into the 9th, the visitors lead 3-2, right? Well, visitors don't score any runs in the 9th inning. And then at the last at bat, the home team hits a triple, bats in 2 runners, 2 runs come in. Who wins the game? The home team, right? Okay? And they have this on the scoreboard that you go to, right? Okay? Now, after that game, if you go to tomorrow night's game, is that information going to still be on the scoreboard? No, it isn't. It's going to get zeroed out, and in a way, they're just going to say, okay, last night's game, we'll give you a win for that game, home team. So maybe if that was their first game, now they're 1-0, right? But now you have a brand new scoreboard, and it's all zeroed out. Is that correct? Okay, I want you to keep in mind this. In a way, the results of this game were flushed into the record book of win-losses. Okay? All right, and you start all over with a brand new empty scoreboard next game. Well, that should be kept in mind as we talk about closing journal entries and the closing process. We kind of intuitively know this, but at the end of every period, we're going to reset certain accounts to 0. And you kind of intuitively know this. If you went and looked at the financial statements for Coca-Cola, for example, and looked at their income statement, would it show revenues and expenses that were accumulated since the very, very beginning of when they started the company 100 and some years ago? No, it's just for this year, right? Okay? So there has to be some sort of resetting or zeroing out of these certain accounts. Is that correct? Okay? Now, not all accounts are closed, but you're going to see that we're going to have certain accounts that we need to zero out and have them be ready for the next period to start keeping track of things, right? Okay, you can come off that for a second. We intuitively know this, right? If you asked me, how much do you make per year, or how much do you earn, Dave? I mean, I wouldn't tell you my revenues that I have or my earnings ever since I was born, right? Going back to when I was a paper boy and then worked at Pizza Hut and then got my, no. I would say like for this year, right? Same thing with expenses. So there's some sort of zeroing out that takes place. I had a student once who worked as a used car salesperson. Has anybody sold used cars here? No. And he said it was just like the movies or the TV shows. They have a big whiteboard, and the new month starts, February starts. And they write each person's name up there. And every time you sell a car, they write the amount of the car that you sold. And it gets kind of competitive, and everybody, they rang a bell. They rang a bell when you got to go write something, when you made a sale and you could write it on the board, right? And it gets competitive, who can sell more cars and more higher dollar cars. And then what do you think they do as they're getting ready to go home on February 28th? What do you think they do?
Erase the board.
They erase the board. And it's time to zero it out, and March, there'll be a clean board when they come in the next day. Correct? It's kind of what we're doing. Okay? So back to this. We're going to identify the accounts that need to be closed, need to be zeroed out, and we're going to record and post those closing entries. And then we're going to learn about, not today, but eventually we're going to learn about a post-closing trial balance. Okay? Now, the first thing we need to do is we need to recognize that there are two types of accounts. There are temporary accounts and there are permanent accounts. Permanent accounts are not closed. Permanent accounts are not zeroed out. We do not zero out every account on our books. We do not zero out the permanent accounts. What are the permanent accounts? Well, all your assets are permanent accounts and they are not closed. All your liabilities are permanent accounts and they are not closed. And your owner's capital is a permanent account and it is not closed. Okay? Coming off that to me again. This should make sense. Mpo, if you had $1,400 at December 31st in the checking account, that's an asset for you, right? When you come in January 1st of the next year, is that zero? Is your money gone? No. Well, what if you have like book value of $25,000 worth of vehicles? Well, the next day you come in January 1st, are all the vehicles gone? No, they're still there, right? Huh? Hopefully, yeah. What if you owe $18,000 on a notes payable on December 31st? When you come in January 1st, do you now owe zero? You wish, right? But no, that liability is still there waiting for you. So we do not zero out those permanent accounts of assets, liabilities, and capital. You with me? Back to the screen. What do we close out? We close out temporary accounts. What are your temporary accounts? Well, your revenue accounts are temporary and they're closed out or zeroed out. Your expenses are temporary accounts and they are closed or zeroed out. Your owner's withdrawal account is a temporary account and is closed out or zeroed out. And then we're going to learn about this new account today called income summary. And it is a temporary account and it is closed as well. So you have to be able to identify the accounts that are temporary that should be closed versus those that are permanent and not closed. Cool? All right. Now, there are 4 steps to the closing process. The first thing that we're going to do is we're going to close the revenue accounts to income summary, to that new account. The second thing we're going to do is we're going to close the expense accounts to this new account called income summary. The third thing we're going to do is we're going to close the income summary account to owner's capital. And then the fourth thing we're going to do is we're going to close withdrawals to owner's capital. You with me? Okay, and you can leave it on there, please. But what you're going to find is these are the 4 steps in the closing process. If you have a good understanding of your normal account balances, this really shouldn't be too difficult. Okay, I have a lot of students who say, I hope you have a lot of closing entries on the test because I understand this. But I think what you're going to find is the best way to understand closing entries is to do an example. So what do you think we're going to do now? We're going to do an example. All right? So let's take a look. I just made up a real quick and dirty example here. And let's say we have a company here, and this is their situation. They only have 2 revenue accounts, and the balance of those revenue accounts are $22,000 and $5,000 respectively for consulting revenue and miscellaneous revenue. Okay? And then they have 3 expense accounts. They have rent expense of $8,000, advertising expense of $1,500, and salary expense of $500. Now what we're going to do is we're going to go through those 4 closing entries, that process, for this little fictitious company. Okay? So let me do that. You can write that down while I dig for my pens here. Okay. All right. Now, what was the first closing entry that we do? The first thing we're going to do is close the revenue accounts, right? We're going to close revenue accounts to this new account called income summary, which we'll talk about more in a little bit. That's step number one, okay? Well, we have two revenue accounts, and revenue accounts are normal credit balances. It's consulting revenue and miscellaneous revenue with credit balances of $22,000 and $5,000 respectively. Now, if I want to zero those out, and I do, if I want to zero out or close those out, what do I have to do to them? I have to debit them. So I'm going to do a closing entry, and I am going to debit consulting revenue for $22,000, and I'm going to debit miscellaneous revenue for $5,000. Now, it feels a little weird to be debiting revenue accounts, doesn't it? Because we always credit them. But if you really realize what we're doing, we want to zero these out, right? So let's post these. Well, I debited consulting revenue for $22,000. What is the balance of consulting revenue now? 0. I debited miscellaneous revenue for $5,000. What is the balance now? It's 0. Well, I haven't done the other side of my journal entry here, right? What do I credit for $27,000? I credit this account called income summary. Are you with me? Take a look at what we did there. Ask me any questions you have. Now, let me say some important things. You have to debit each revenue account. If you have 100 revenue accounts, you have to debit each one. You can't just say total revenue. Okay? Because this is instructing me to go do this, close these out. Let me say something else that's really important. This is a journal entry. This is a closing journal entry. Some people think we're doing like a little financial statement, and I'll see them do something that looks like this. No. I don't know. They're like doing a little financial statement. No. This is a closing journal entry. Does that make sense? Okay, that's the first closing journal entry. Any questions on the first closing entry? Okay, what's the second closing entry? We close the expense accounts to income summary. Is that correct? All right. Well, what are our expense accounts? Well, let's move this up and let's take a look at our expense accounts. We have 3 expense accounts: rent expense, advertising expense, and salary expense. Okay? Now, they have normal debit balances of $8,000, $1,500, and $500, respectively. Okay? We have to zero those out. Well, how do we zero those out? What do we have to do to each one of those expense accounts to zero it out? We have to credit it. So we are going to, I'm going to leave a little space here to do my debit, because debits and journal entries need to be first. But I'm going to credit, hold on here, debit, credit. I am going to credit rent expense for $8,000. I'm going to credit advertising expense for $1,500. And I'm going to credit salary expense for $500. I'm crediting these so I can zero these out. Once I post these, a credit to rent expense for $8,000 a credit to advertising expense for $1,500, a credit to salary expense for $500. My balance of these accounts is now what? 0. Now, what do I debit? What does that add up to? 10,000? Yeah? What do you think we debit? We debit this account called income summary. Once again, folks, this is a journal entry. This is not a little financial statement, okay? Here's another error that I'll see on tests. I'll show you what they do. Well, they list out their expenses, and then they have a line here, and then they say total income summary, 10,000. No. Okay? No. This is a closing journal entry. We need to credit these accounts, as I've shown you, and we debit the balance to 10,000. Are you with me? All right. Questions on the first two closing entries? Anybody? By the way, do we know, did we have a net income or a net loss situation here? Or do we know?
Net income.
We have a net income, you're right.
17
Of 17. How do you know that, Mpo?
minus the expense from the.
The total revenues were 27, the total expenses were 10. You're right, we have a net income of 17,000. Okay, what was the third closing entry? You remember? The third closing entry is to, what'd you say, Ross? Yes, we're going to close income summary to capital. Now, I am not saying we close capital. We are not closing the capital account. The capital account is a permanent account. We don't close it. We close the income summary to capital. Now, how do we do that? And I realize I haven't really talked about this income summary account. I haven't forgot. Well, what you need to do here is you need, after you do the first two closing entries, you need to do a T account for income summary. Okay? It will always have a 0 balance to begin with. Now, we credited income summary for 27,000, didn't we? And then we debited income summary for 10,000, didn't we? So now what is the balance of income summary? Looking at the screen. Isn't it a $17,000 credit balance? You with me? Okay. Now, the third closing entry is to close income summary to capital. How do I close income summary? What do I have to do to this T account to zero it out? What do I have to do? I have to debit it for 17,000, and that will bring it to a 0 balance. So the third closing entry is I debit income summary for $17,000. And what do I credit for 17,000? Capital. Now, Mpo, you told me correctly that we had a net income situation, didn't you? Doesn't this and you said the net income was 17,000, right? Correctly. Doesn't this kind of make sense if you know your account balances? Because what is the normal balance of a capital account? Is it a normal debit or credit balance account? It's a credit balance account, right? So we are increasing capital by 17,000 here, aren't we? So do you see where this is kind of a zeroing out of your revenues and expenses and like flushing the results into a capital increase? And remember the very first quiz I gave you, one of them, where I said, what increases capital, and I taught you about the statement of equity, and you could see that net income was added to capital on the statement of equity? Doesn't this kind of make sense? Because we have a net income situation because our revenues are greater than our expenses. And by golly, by gum, we are increasing or crediting capital. Okay? You with me? Does that make sense? I realize we haven't done the fourth closing entry, by the way. Any questions on these first three closing entries? Now, you have to get the number that goes into this third closing entry. You have to do a T account. You have to do a T account for income summary. And you credit income summary for 27. You debit income summary for 10. You figure out your balance. Doing this T account will give you the number that goes in that third closing entry. Okay? Don't shortcut it, folks. Do the T account. I've been doing this for 25 years, and I still do a T account after the first and second journal entry, first and second closing journal entry, to see what number goes into the third closing entry. And then I always ask myself, does this make sense that capital is increasing? Well, yeah, it does, because we had a net income, as Impo said. All right? Now, come off that for a second. And again, I know we have a fourth closing entry to make. We'll make that in a second. If you're a good student, at this point, you should be saying something to yourself. You should be saying, what type of account is income summary? Now, I know I'm training you properly. If when we introduce new accounts, if you are asking yourselves, what type of account is that? What's its normal balance? And what financial statement does it go on? Because if you can't answer those three questions about your accounts, you really don't know what you're doing. So now let's answer those three questions about income summary. Income summary is kind of a weird little account. What type of account is it? It's not any type of account. It's a temporary account, which means we close it out, but it's not an asset or an expense or no, it's no type of account. And it doesn't go on any financial statement. It's a weird little account. What it is, looking back at the Elmo, it is simply a little T account that we utilize. We throw the revenues in there, we throw the expenses in there, we figure out the balance, we close it, and we're done with it. It has a very short life. It's zeroed out, we're done with it, and we don't use it again until the next time we close. You with me?
So basically you just use it to zero out.
You just use it in the closing process. You close your revenues to it, you close your expenses to it, you figure out the balance, and then you close it out. And then we don't do anything with it until the next time we close. In a way, it's like this. You ever made cookies? Okay, coming off the screen. You get a mixing bowl, put your brown sugar in there, put your flour in there, put your eggs in there, put some vanilla in there, put your chocolate chips, a couple eggs, right? You mix it all up, and then what do? Then you take it all out, right? Now, could you make cookies without the mixing bowl? Yeah, you could. It'd be messy though, wouldn't it? Okay, you could try to mix it together on the pan or whatever, right? Yeah. Or you could buy the pre-made, right? But the income summary is kind of like, looking back at it, it's kind of like a mixing bowl. We throw the revenues in there, we throw the expenses in there, mix it up, figure out the balance, and then we take it out. Okay? Now, some astute students have said, why don't you just close revenues to capital and then close expenses to capital? And you could get rid of one of these journal entries, right? Here's the reason we don't do that. We don't like to make a lot of journal entries to capital. But by doing it this way, when I go in and look at my books, I can see that we credited capital for net income. Does that make sense? So it's just fewer journal entries we have to make, okay? Now, I haven't forgot, we have one last closing entry to make, and what is that one? Yes?
If you had a net loss on
Very
that,
good.
would you debit capital and credit income summary?
Very good question. Impo asked, what if we have a net loss? Well, if we had a net loss, this would have a credit balance, and we would need to debit income summary, and, I'm sorry, I said that wrong. If we had a net loss, that income summary would have a debit balance. We would have to credit income summary and debit capital, which would reduce capital. And we will do one of those eventually. But that's a great question. Okay, the fourth closing entry is we close the withdrawals account to capital. Not to income summary, but to capital. Is withdrawals a normal debit or credit balance account? What is it? It's a debit. So we have to credit it. I didn't give you a withdrawals amount or T account. Let's just say withdrawals are $1,000. Well, then we would credit withdrawals and we would debit capital for $1,000. And that zeroes out withdrawals, which is a temporary account. Okay? Does that make sense? All right. Questions on that? You can read your book. Closing entries, though, aren't too bad. All right?